So I don't know exactly um, what it is that I want to title this video, but I do know what it is that I do want to talk about within this video, and that's pretty much just the state of the type of market that we're pretty much dealing with this week. There are some heavy news drivers. As you can see, I have a Forex Factory pinned here on my right hand side, so you can see the news that's to be in expectancy not only for today at 8:30 and the rest of the day, and tomorrow at 8:30 we have some red news folders, and then again at 10 o'clock. So primarily I just like to see um, exactly what happens to the market when news data and things of that sort, such as federal funds rate, is priced into the marketplace. I come here just to do that framework of back testing, and gives you a bit of better understanding of pretty much what type of state the market might be in expectancy for news to release. In this sense, the way that you would apply it to trading is pretty much thinking in the sense that in the AM session, New York session of the market's delivery, whatever price comes out, usually you'll see the market consolidate, chop, whipsaw, play both sides of the market. And then after 2 p.m., when that data comes out for the federal funds rate, that's when you actually see the real move come into play, because this data is already priced into the marketplace. So, with that being said, there's no reason on why the market should already do what it's predetermined to do. So, I'll just clear some of this up just so you can see exactly how I'm looking at a price and just correlating it with news. So I guess I could just, I don't know if I went over these things already, but I could definitely just go over I guess Tuesday and Wednesday. Tuesday was really the day that I took trades. I don't believe I caught anything Monday, but this sell off here, I did catch that. So I'm gonna unpin this because I don't need this there anymore. Go ahead and zoom in, and now I can really tell you everything that I was looking at. So this is price off of the hour. You can see on the hour what it's looking like. Guess I'll do a little top down. Pretty nasty in a sense, but I don't know, there's always opportunity somewhere. So I drop back down to the hour. Put my levels back on. And then from there we'll scale down to like the 15 minute and keep dropping down lower. Just so you can see everything that I was looking for with Monday's PA. Like you see, midnight opening price. We open here. The market trades up higher. Of course, the whole basis behind the short idea is if you want to see the market, potentially deliver to the downside, then we need to be above midnight opening price. We need for a liquidity grab or sweep, more than likely into a PD array. Um, and if it does continue to keep trading higher, then of course you would want to see the macro get swept as well as it continues flowing up, and then you wait for that confirmed break going down into the downside, given that change in state of delivery. So I didn't identify the entry model off of the 5 minute or the 15 minute. I believe it was a 1 minute entry. Let me damn, did I enter in here off of the 30 second? I probably did. Because price is fractal, so it doesn't really matter what time frame you enter off of. It's going to be the same shit. So this is what it looks like on the M1. I mean the 30-second chart. I'm gonna turn the entry for the chart executions so you can see exactly where I got in at. So when I first got into the marketplace here, I pretty much got in for a short around like 850, I think like 848. I was in a short right here. Pretty much I was in it too early. I was definitely looking for a confirmed break to the downside and for us to keep traveling lower. But it ended up coming in sweeping under this low. And yeah, it rallied against it, and then we had a whole impulse price swing to the upside. So this was due to my mistake of trading the market before 9:30. Was I got caught in a Judas swing. So this is the 9:30 opening here. Pretty much got caught in a manipulative price swing heading to the upside. And I should have waited for that 9:30 to pretty much open, push price, manipulate whatever it needed to manipulate up here, and then look for that sell off, which is pretty much what I caught here. So my first entry, I was in some pretty bad drawdown from here and then rallied all the way up here. That's where I exited. So after I seen the market rally up in here, really, I'm using proper risk with my account. So I was already risking 1%. I was looking to pretty much hold that bad entry and expectancy that the market was gonna correct itself and drop off. But then again, I shouldn't be in that much drawdown anyway if the trade idea was pretty much right. So I closed that first entry out and got back in with two contracts here. So pretty much what I was seeing was the sweep of liquidity, the turtle soup. The market comes in, traded to like some very small fair value gap here. Price was respecting that, so I sold short in this down candle and pretty much caught the whole ripple from here all the way down to here. So that was a pretty nice move. It's about 68 points. So that's really all I need. It's a catch 1% every day if I can. If the market does give me more, that is nice as well. But sometimes you can't really predict that the market is just gonna sell to hell and just give you these nice moves into the downside. A lot of the times I'm just gonna take whatever I can get that fits within my model, and I let it be. So this fell all the way down for like another 117 points. So that was a pretty clean move. So it was pretty much like all I had took for the week right now. I didn't trade yesterday. Um, Yesterday was more so just I guess, experience what price was gonna do with the federal interest rates being released at 2 p.m. So I didn't trade at 2 p.m. But it is nice to see how news does drive the market when you already have data just waiting and sitting to be priced in. I just give like the rough breakdown, I guess, of like how I'm using the federal interest rate data to get an understanding of what the market is pretty much trying to do: reach for, take, grab, running of stops, etc., etc. Give me a second. Let me zoom in. So, looking at Wednesday, you can pretty much see how at one point in time this was the high of the day. Monday's PD array was rated. We ended up getting that scenario where the market has now created the high of the week, the high of the month, the high of the day on Tuesday. And after it consolidated, it traded out of that consolidation and showed us a reversal. Within that reversal being formed, we know if it's a true reversal once that change in state of delivery or that confirmed break. I like identifying my confirmed breaks off of the swing lows that take out the high. In a way, this would be considered a change in state of delivery, a break in market structure, or also known as a breaker block. Um, After that was identified, really, if you didn't get in here, you could have got in here and expect that the market was going to continue the downpour, giving you that break and retest scenario into the downside. So it did deliver the goose, from 9:30, creating the high of the day, and from there the whole candle just flipped off bearishly, and then we end up attacking Monday's PD array that got rated right here at 2:30. I believe that is. So you got 12, 1, 1, 2, 3. So at 3:30, ended up trading right here into Monday's PD array and closing off for the rest of the day with that range. And then right here on Wednesday was pretty much a great opportunity to be, looking to take a short maybe, or the market, was just prepping itself for that MMXM. In other words, this was, a market maker buy model. The market pretty much creating sell side inefficiencies for the smart money rally. I think it's called SIBI, sell side inefficiencies for buy side liquidity. That's pretty much what the market was attacking. So creating sell side inefficiencies for buy side generation here. That ends up happening at 2. So guess what you can do, or what I do, is I just identify what that 2 o'clock candle was, which is right here, 1400 GMT. And from there, I take the opening of that candle, the high of that candle's range, and also the low of that candle range at 2. And just studying what price it did with interest rates remaining the same. I'm pretty sure the dollar just maintained whatever the hell it was already at. I don't believe the interest rates being remaining the same was actually good for the currency, because if it was, we would have seen a lot more selling opportunities into the downside versus it coming down here to grab orders resting below Tuesday's low. Tuesday's low was pretty much representing the low of the week as well at one point in time before we came down here and manipulated it at pretty much 2:55 to 3 p.m., the ending of this macro of that 2 o'clock candle. We end up running below Tuesday's low, taking out that PD array. And then you usually expect for the major reactions to happen around key levels, high of the day, high of the month, lows of the monthly, weekly, daily time frames. Those lows and highs do have some type of significance. I did have the opening prices for the rest of the news drivers that came out on those particular days, but honestly, ADP non-farm employment in the change did nothing. The advanced GBP plus PI index really did nothing to the marketplace. Really, where that real data started to come into was that 2 o'clock opening with at 1400 GMT with the federal funds interest rate. So I'll mark this off, but the data pretty much remained unchanged at 4.5%. And if you give me a second, I can also pop up TradingView, because now I am very curious to see what the dollar index did at 2 p.m. once the federal funds rate came out, that data, since it remained unchanged. So give me a second. I hate when I get a little bit off topic here, but a lot of these things are very important and they tie into each other. So I just want to look at the dollar index. It's pretty much what this is going to be used for. And I just want to see what price did at 2 p.m. So I'm going to clear all of these drawings. And I just want a vertical line at 2 p.m. I want to see exactly what price was doing. So at 2 p.m., we had the market open, forming the low. And we had a scenario where pretty much the market came down here, turtle souped. Just a run in of stops, pretty much a raid on sell side. So now I'm just breaking this down just to see exactly why the market was bottoming out here. And you can see it pretty much open, The trade down below rallies up, comes down, rallies up, comes down, turtle soups, creates a bottom, and then from there, pretty much looking for upside objectives to be targeted buy side. Uh, at 2 p.m., this is pretty much what probably signaled off the sell off was the fact that the dollar was raising as the interest rates remained unchanged. So pretty much had this scenario where it came up here, boom, created a bottom, and then rallied to the upside. So in there, pretty much you could find like some type of SMT with NQ, as in the market created higher highs right here, and this SMT could pretty much be correlated with the dollar. I do like using the dollar in this sense for identifying bullish and bearish SMT with indexes, because this does have some type of impact. SMT plus DXY. So this pretty much would be used as a confluence. And then let's go ahead and pop that chart back up. Boom. So you can see here how we create low, higher, low. And then we have low, lower, low. So this right here is showing me that we have some bullish SMT down here. But of course, I really wouldn't be using it in the sense of trying to identify this. I would really probably be using the sense of identifying that. We have higher highs being taken. And then right here, we have lower lows being swept. So this is pretty much that idea that if the market is showing us that it clearly wants to go up higher, but then we have the dollar index showcasing that it wants to go lower, that's pretty much a sweep of sell side liquidity being generated, or for the buy side inefficiencies. That's probably why the market sold off at 2 p.m. And I'm over here having technical difficulties, but trying to break off this damn full screen. There we go. So now I can pin trading view to the side. So my bad. This 2 p.m. I'm sitting here looking at this. I should have been looking up here. So you have the market pretty much sweep highs, creating some type of SMT right here with the lows on the dollar index. So sweeping highs, taking them stops, rate of liquidity. The market trades off at 2 after creating the high of that candle. And then from there, it breaks down, pretty much sweeps all of the macro sell side liquidity. It already poked and traded underneath the low of the day, so that new low of the day would have been right here where sell stops would be resting underneath this old low, and then trading all the way into the PD array for Tuesday. And then after that, it pretty much just went in like a dead state, where now we just like sitting in this little range here. But it was definitely there. The signal for the sell-off was definitely there, but also was pretty much expecting for the market to rally to the top side due to the interest rates remaining unchanged. It's probably just going to keep its bullishness and poking the all-time highs again, which is pretty much what it did. So it's crazy in a sense. Hopefully I explained that right for you guys. I definitely don't like passing out wrong information. But again, I'm learning just like everyone else every single day. So that was pretty much like the basis behind this trade idea, I guess. But I didn't participate in this. All I did was pretty much just watch it. Seeing the market consolidate in the morning, whole morning session pretty much just chop. People probably losing accounts. And then at 2 p.m., that's when the actual move actually begun at 1400 GMT. We sweep highs and then we break down to the downside. Same type of confirmation I would look for my shorts when it came to Tuesday's trade is the same thing I would look for Wednesday. So we see how the market comes and it breaks this focus point here. This focal point pretty much was a swing that drove the market higher. So once I identify that, I will see that as a true break. And then from there, my whole bias of being a buyer in a sense is completely changed already due to what I see happen up here. The market made a high, what right here made a high, higher high, and then a lower high. So seeing that sequence, that three drive sequence, pretty much lets you know that the market is showing weakness in its upside. And if it breaks below this low, it's probably going to be a confirmed break into the downside, which is why it rallies below these lows, takes out liquidity resting below here. Again, wicks just show the last state of what price was perceived. But honestly, I like looking at body to body closes. That's pretty much where the real volume of the orders are. So wicks just help you identify like the lowest point that volume reached, which is why I look at certain levels than the others. I just like to see exactly like where the volume ended at, and anything from the ending of that ending of that volume to above it is pretty much just resting liquidity from a macro level that you can also look to get swept as well. So hopefully that makes sense. I'll go ahead and uncheck all of this. That's why I just identified this red level here, because this level here where sell stops is resting, not only a sell side liquidity and stops resting below here, but that's also the low of the day, which is a key level that's getting traded into. So really you could have just capitalized off of the short. I wonder if that sequence with the high, lower, high, high, higher, high, lower, high was made here. Yeah, so you can see it. Same thing on the 15-minute. Have that high, higher, high, lower, high, sell off, break, work a market structure, CISD, change in state of delivery happens here, then the market rallies and trades lower. So if you was to like getting off of some confirmed break like that, 15 to 20 point stop, that's usually what I like. And you target sell side liquidity, 60 points, about a 1 to 3. Of course, Tuesday, which was representing the low of the day, also the low of the week, has about 89 points. And then as it continues to keep making structure, every single low, you're pretty much looking to get swept until it doesn't. So that was 110 points, and then the very, very final point it reached to was about 153 points before it ended up flipping over and giving us some type of confirmed market structure shift after rallying through so many key levels. Um, Definitely could have seen why it would have bought after running out such key levels resting down here, such as the low of the day and also the low of the week. So we trade in off of the low of the week. Of course, we expect for sell stops and liquidity to be taken from those higher time frames as well. And once that does happen, usually price trades to and through accumulated market orders near the key levels, and then you look for a trade to unfold in a new direction. Pretty much a reversal in a sense if you understand the four market conditions and pretty much how the market algorithm works on a engine of doing these four things over and over again, which is pretty much retracements, consolidations, reversals, and then of course market expansions. If you think about it in that sense, these things will pretty much make a lot more sense. If I had to break it down to you, and we see where the market pretty much consolidates here after taking out such a huge draw of liquidity and trade through those key levels, especially the weekly time frame holding so much confluence. You definitely don't want to see the market stay under here for too long, but you definitely want to get an idea of where it could possibly bottom out at. So in other words, you don't really even look to even take a trade once the market breaks below some low of the week. In this sense, you want to see where exactly is the market trying to take price to, and where could a confirmed shift in market structure happen, for that upside movement after we come under such a high time frame level. So I believe I had that marked up as well. Probably was a fair value gap or something of that sense on the 1 minute after that protective low was made down here, creating the new low of the week. So there's some updating and things of the sorts that I need to do to my charts for this morning session, because I only have about an hour left before I begin my actual trading. Trying to see where that fair value gap was at. It definitely was one down here. So yeah, that's pretty much what I was identifying off of the 30-second chart. So the market came right in here at that 30-second chart fair value gap. No, I'm darkening this just so it can be seen. So price comes right in here, creates the new low of the week after trading through the previous low of the week level. Um, Price trades through, and you look for it to come back to it on the opposite side, and then that's like, okay, that is signaling off in my head that it is not really a confirmed real break. Price is probably just coming down in this level, grab something that we trade back through that level on the opposite side. Then of course I'm changing my mind from being a seller to a buyer. So you pretty much try to identify exactly what would shift that perspective for you. If I look at this from the higher time frame, I believe like the 3 minute or 5 minute, I just like coming up just a little bit higher on the time frame, just so you guys can get a better perspective on how I'm identifying my key levels with price. It pretty much flipped my perspective for me into taking these type of entries. So if I take a brush, you can see this swing high point right here and this swing low point, and then you have like a macro swing high point here, and then this higher low right here. So now if we go drop back down to that 30-second chart again and just look at those key points, uh, it's gonna be the same shit on every single time frame. Definitely try to preach the fractalness of price over and over again, just due to the fact that it's just how the market works. So now looking at it off of the 30-second chart, you can see how that swing low down here is the low of the week, and we never come back down to this area again. So you can see where the shift in market structure happens. We already had an early sign of it here. So the market shifts market structure completely, and we change from a sell bias because it failed to trade underneath this low. So now we are within a buy bias where we're looking for the market and now continues keep trading higher. So that swing point right here in that 15 minute, probably some high on the hour, some high on the 4 hour, etc. We look for the buy side resting above there to get targeted. So if the market already broke here, shifted market structure, this is pretty much where you can now set the Fibonacci. You can either do body to body closure, or you could do from wick to wick. So I'm taking the low of the wick from the low of the week and dragging it to this macro swing high here, and now that's giving me a golden kill zone also within the Fibonacci, between the 70.5 and the 79% retracement level. I know you probably can't see my colors because it's very mellow toned out. I like to keep everything very light and clear so I can see the charts, especially when I have like a lot of these levels and things of that sort identified. But using that fib, dragging it from this swing low point to this swing high after grabbing the concept behind, what is a confirmed break. Here is pretty much where that break happened for us. And I'm just deleting as I go because I'm at this point, like, you can always just spin the video back. But that confirmed break happened right here. And I'll make this a little bit more beefier. So this is where we had our first identification of, okay, we are no longer within a sell trend anymore. The market is giving us signals that it possibly wants to go back up. Accumulated a lot of that sell-off. Taking the fib from this low here to this high grabs us a entry based off of the fact that we expecting the market to hold off of this low. So that's where you're, going to be setting your stops and things of that sort. So the fib from that low to this high gave us the confirmed entry. There we go. For this to happen around here. And let me delete that. So That's pretty much what the Fibonacci is being used for. Use it after a confirmed market break, especially when you trade through key levels. That whole confluence is like this. We don't want to see the market stay below here with the low of the week trading down into this area and then continuously trading downwards. We want to see price come down to that low of the week, respect it, accumulate some type of orders around that level, and then look for it to trade back through it on the opposite side. So this is how you get your, your opportunities to be able to trade into these models. From that low to this high, you grab your entry here. Long position anywhere in that area is valid with a 15 to 20 point stop. Honestly, you would look for your SL to more than likely be underneath the FEG low. In this sense, this is just perfectly fine. Maybe 20 points would have been what you needed to actually trust the model from down here. But now, as you see from there, we get in. The market respects this low to this high sequence after taking stops, resting up here, and it just continuously keeps generating that structure that we like to see at these swing points. Just creating that higher structure. So you see we go low, higher high, in a sense, from high, higher high. Then the swing lows are pretty much respecting every single low. So low, higher low, higher low, higher low, higher low. And then you see we just respecting that trend going up. And then you look for the market to pretty much trade into these old highs in a sense with the new price action. So that's when you can start, looking at your fair value gaps and things of that sense and looking for old highs to be broken. Last two up close candles, order blocks to be traded into. That's when the concepts really start working. So identifying market structure in a sense and having a very good understanding of market structure can change your perspective on how you look at the marketplace. So from there, we trade into the low of the week level here. PD array, 2 days low, low of the week. We trade through it, and then we come back and trade back above it. I would no longer be looking for sells. I would be looking for longs. So you can identify, how would you be able to get into the longs if there was no confirmed entry here for you. With catching a retracement with a fib, from this low to this high, maybe you're looking for it to fill about 50% of that range or come into like the 70.5, maybe 62% of the retrace. It doesn't, but it does do, a market break. And then you also have a turtle soup here where the market comes down, comes below this low, 15-point stop. You get in here and you look for the market to continuously keep spooling to the upside, giving you breaks, breaking highs, trading up, coming and retesting those highs, giving you other entry signals, filling in a fair value gap, trading within there, and you still looking for the order flow to be respected and just keep rallying higher. So that's really where you start seeing the concepts and things of that sort for the entry models just pan. Everything just starts to make sense. You see the order blocks are working, fair value gaps hold up. It's just everything is in your favor when you're on the right side of the marketplace. And then, that could have been a entry signal, whether here, turtle soup, breaking the old high, looking for the market to come down, forming some type of support, trade up. Same thing here, created a fair value gap. This right here would have probably been a way better entry for a person to possibly participate in, which is this fair value gap right here. 3 candle sequence right in that area. And then you look to buy here with your stop set below this low. So that's like 29 points worth of risk. Really, you would wait for it to fill in or trade all the way down into the closing of the fair value gap and try to pretty much get an anticipation of where it's about to bottom out at. So another thing you could have waited for was like another confirmed turtle soup entry, a false break underneath an old low. Happens right there. So it comes up here at 1553, trades underneath that low, filling almost entirely the whole fair value gap for inefficient pricing purposes. The market does not like leaving those voids in price, so usually you look for a trade idea to happen after it fills. And with it getting filled, The market gave you an opportunity to wait for a correction, and pretty much you buy the false break. So here you would have been looking to get in here right underneath that low, 15, 20 point stop. That's usually what I do. And you look for the trade to execute, respect this, not coming past this low. Really, you don't even want to see it go any lower at all from this area. And you target what? Old swing highs, as you see here, resting buy side, 31 points, 1 to 2. But you're looking for more because, of course, we're looking at this on a 30-second chart, but you have that 1 hour, 4 hour daily perspective of where price is actually trying to go. But you have to understand how to enter into price to know why it makes such these dramatic moves into the upside. And this is pretty much how I've been catching a lot of my high risk to reward trades, where I'm maintaining such a high win rate and also, a huge risk to reward as well, because I'm trading with the right side of the market. I'm trading where the volume is, where the expected volatility is, and I'm looking for all confluences that pretty much put me with the buy side of the curve or with the sell side of the curve. And within those moves, you're able to catch like fucking 198 point trades, 200 point trades, and trading what one contract with NNQ, attacking the high right here of the federal funds interest rate, because this was the high of that 2 o'clock candle that we end up manipulating and running through once buy side was grabbed above there, and it literally just kept going up. So it didn't go to and through and then trade off and sell. It kept going. So that's just one of the things that you have to expect with price. But just gathering like from these two trades put together is like literally a 353 point two point trade. And if you just take a simple calculator, I'll do the math for you guys real quick. But 353 points, 0.25, and times that by $20 per point is literally 7 grand being spanned across two entry models, one here and one here. And you look for the complete exit here at the federal funds interest rate high, that 2 o'clock high here that I'm showing on the 1 hour. So ones that actually trade like smart money concepts and things of that sort, you guys will already know exactly what it is that I'm talking about, and these things will appear to look a lot more clear to you now. But for the ones who don't, man, all I can really say is please either join my free Discord, so I can give you information in regards to how to trade smart money concepts, or really all credit goes to ICT. Anyone that does follow the Inner Circle Trader, or indulge in his content, then you already know what the deal is with that. These concepts work. The market respects these models, and it just happens over and over and over and over again, repeatedly every single day. And this is pretty much how I've been trading, and the thought process that I've been having behind a lot of my trade ideas, that is pretty much making me money. So I really have nothing else to talk about when it comes to the charts. As you can see, like, I'm gathering my entries by understanding what price is trying to do from a higher time frame perspective. But of course, I have to understand the intricateness of that fractalness of price on the 30-second, 15-minute, 5-minute chart, going down there to gather my entries. And I'm looking for price to hold with what it's trying to reach into on the 1 hour, 4 hour, those levels. So that is that. That is pretty much why I target the high of the month, etc., because that's where price is showing that it wants to go to on the higher time frame. Trading into that fractalness of price, and just identifying all the key levels, things of that sort, it does help you stay in line with the order flow. It's pretty much what this is. You're just following the order flow. So that's why I take the eye check thing off and put it back on, so you can see how identifying the order flow pretty much puts you in with the right side of the marketplace, along with having your key levels. So I don't know exactly what it is that I want to title this video, but I just wanted to touch up on pretty much what happened this past week. The week's almost over, so I usually do trade recaps and things of that sort. once we approach the end of the week. Sometimes I'm still undecisive if I want to take, trades on particular days. Really, I just look for my model, and once I see the model, happen, I take the trade, and just it is what it is. I make money, and then I make it. If I don't, then I just lose money. But so far we have all five of the 150K combines still active, still trading. Um, Doing the same thing that I was doing with my 50K accounts, but now I upscaled. So I have max allocation. I'm definitely going for max allocation, 750K in funding. And after I pretty much put these accounts into a funded status, I'm still stuck in between, do I want to keep trading NQ once it's on the funded side, or do I just trade macro with half the contract size that I was using? Because I'm risking $20 per point. Um, Definitely want to keep my well, not my combines, but the expresses for a really long time. So I might end up dropping down to micro NQ and trading half of the positions that I'm using on NQ. So I'll trade like 5 micro contracts on MNQ and risking $10 per point. So that way I can have like a proper 30-point stop, risking $300 and just make money over time until I build like a solid buffer and things of that sort. Because that's pretty much what I did in the 50K accounts. I traded NQ, really micro NQ. I did it off of micro NQ, but traded micro NQ with a little bit of NQ depending on the setup that I seen, and I was just using those two indexes, the micro and the E mini version of them, to scale the accounts up, make 3K, and then once I made the 3K target, that's when I went ahead and started running it up, doing the same thing in the express side, building a buffer, and then after I built my buffer, I took a huge payout of over 10 grand because I had like two big payouts, and then from there, pretty much rinsed the accounts completely out. In all, I've made over $15,000 within the course of like 2 months. So after I upscaled those accounts, I went ahead and got bigger ones, and now I got 750K in funding. Uh, the accounts are up 2.3% across all five. So if I was to do the math to that, times that by five, I am up $11,771 across 5 accounts. Yes, this is the combine, so it doesn't really necessarily matter. But with me having a target value of $9,000 across 5 accounts, I have to make 45 grand. So if I'm already at like a 11.7 or something like that, um, I got a long way to go. So I have like another like 30 something plus $1,000 to go before I'm able to pass all these accounts. But really, just 9K. It's copy traded. I'm just looking at one account, but the others are following. So copy trading is very, very easy. It's simple. I just think of it in the aspect of like I have one account, but there's others following. So if you do right with one account, there should be no problem with you trading multiple accounts because now you're just gonna make more money for being consistent with one account. And that's pretty much how I think about copy trading. So only lost about 4 trades. Took 16 in total. That's about 20 trades. So across 20 trades, I've only lost 4 with these accounts. Here's my average. Now I'm ass. No trades today. Obviously, profit factor 1.2. Gained with about 5,000. Lost about 2.5. Overall net positive anyway. Best day profit. I made about 46.16% of the account in one day. Is my equity curve. Every single day has pretty much been break even or positive. Excuse me. Tuesday was pretty much like my best trading day. For some odd reason, every Tuesday I've been smacking the market upside the head for some reason. Tuesdays have been my best trading days. So I made 1% on Tuesday. Total trades 20. Number of lots traded 36. Average duration in a trade about 11 minutes. Average win duration 10 minutes. Average loss about 13. Worst trade lost 1%, 1.1%. Best trade made 2.2%. So pretty much net positive 1% because that was pretty much the trade that I had took on the 29th, and that was on Tuesday. Yeah, so on Tuesday Took a loss and then got back in for that short, and that was pretty much the trade that I was talking about. So enough about the statistics. All I have to do is just scroll through, and you can get the feel of what it is that I'm doing, how I'm maintaining my accounts, and really just limiting myself to like one or two trades. If it's anything more than just one or two trades, the trades were possibly like re-entries back into that flow of the side of the market that I'm trading. And if I get it to pan out once the flow is in my way, then I set my my SL into break even, just securing some type of you know respect for my balance, and not wanting to see that account balance drop below that that price level or whatever. Um, and just maintaining, trading smartly, doing the best that I can every day. And that's pretty much it for this video. So I hope you guys enjoyed a little, I guess like a overview of my account, and then a little understanding of news drivers in a sense. How they impact the market and correlate into the theory of time and price. So that's it from me, and I hope you guys have an amazing morning and a good trading day.